Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about some major changes that might be on the horizon for superannuation. Now, of course, the Albanese government delivered its first federal budget last month and it was a bit of a fizzer in terms of it really didn't include too many changes to super or really other changes that affected investors. But of course, given high government debt, there's always a pressure on the government to increase taxation revenue, and playing around with super, particularly how super benefits higher income earners, I think will be a very attractive thing for the Albanese government to do. And really, subsequent to the federal budget, there's been, a few murmurs by politicians and that might hint at, some of the changes that they're contemplating. So I thought I'd talk about them, and then also address, how does it affect you and what should you do as a result of these murmurs or potential changes on the horizon. The first potential change I'd like to talk about is increasing the tax on contributions into super. So for most people, particularly lower income earners, if they make a contribution into super, and this includes the employer mandated contributions, that those contributions attract a flat 15% tax rate. However, back in 2011, the Gillard government introduced a higher rate of tax for higher income earners, and that new rate of tax began on 1 July 2012. So it's been around for about 10 years now. And the purpose behind the tax was to reduce the taxation advantages that super affords higher income earners. Not in percentage terms, they're on par on percentage terms, but a 30% or 37% tax saving to lower income earners in dollar terms is a lot less than higher income earners, of course. And this tax is called Div 293 or Division 293 tax. And the ATO calculates that at the end of each tax year and sends you a bill, and you can pay that either from your personal name or you can forward it onto your super fund and they'll pay it out of your account balance. Div 293 tax applies to anyone that earns an income in excess of $250,000 a year. And as I said, their contributions, instead of being taxed at 15%, they're taxed at 30%. Now, between 2012 and 2017, the threshold was actually higher. It was anyone that earned over $300,000. So, and they reduced that to $250,000 after 2017. So I guess there's already history here where the government can play around with this income cap, and reduce it further in order to generate more tax revenue. And the way that they could sell it to their constituents is it's only higher income earners that are paying the higher tax rate, and that's only fair in their mind. The stage 3 income tax cuts begin on 1 July 2024, and that means the highest marginal tax rate begins at $200,000 instead of currently $180,000. So potentially it might be good to harmonise those two tax rates so that if you earn over $200,000, your contributions are taxed at 30% and any income in excess of $200,000 is taxed at 47%. And again, that would be one way to generate higher income. Of course, higher taxable income for the government, of course. Of course, when there's legislation that has certain income caps or limits, it's always tempting for governments to change those limits in order to generate more income. So it's not difficult to really, guess or predict, what the government might be thinking. The next change, which I think is a bit of a no-brainer and probably should have been introduced many years ago, and one that I think the government will actually implement, is having a cap on the amount of money that you can have inside super. So currently there's no limit. You can have 10 million, 20, 30, 50, $100 million in super if you want to. Of course, when you retire, there's what's called the transfer balance cap, which means that's the amount that is tax-free when you go into retirement, you start drawing your pension from super. And so the first 1.7 million per person is tax-free, and then anything in excess of, any balance in excess of 1.7 million, any earnings on those investments are taxed at the standard rate, so 15% for income and 10% for capital gains. But it doesn't make a lot of sense, does it? Really, if you do actually have $10 million, the first 1.7 is tax-free. The remaining 8.3, okay, you pay tax, but certainly at a concessional tax rate. So I think it makes sense then to bring a cap and say maybe people can have up to $5 million in super, and then anything in excess of that they've got to take it outside super and either put it in a trust environment or in their personal name, and that would be a good way for governments to generate more tax revenue, particularly from ultra-rich individuals, and that kind of seems fair to me. I mean, one of the reasons for concessionally taxing super is that if you levy a lower rate of tax on retirement savings, then more people will be self-funded retirees, and there's less burden on the welfare system. Well, I think if you still implement a cap of $5 million, even if you do that, and someone's got $10 million, well, I don't think they're going to be a burden on the welfare system anytime soon. So why not just increase the rate of tax? They can afford to pay it. They've got excess funds. And really the role of super is really once you're self-funded and you can have a comfortable retirement and you're not going to be a burden on the welfare system, any excess, any sort of wealth in excess of that you need to achieve that, I think it's fair to tax at the usual tax rates. Which leads me into the next possible change, which is that transfer balance cap. That is the amount that is tax-free once you start entering into retirement phase. So once you start drawing a pension from super, and as I said, at the moment that cap is $1.7 million. It means that that the first $1.7 million, any earning or capital gains on those investments are tax-free. Anything that you take as a pension, draw as an annual pension from super is also tax-free. If you have an amount in excess of 1.7, as I said previously, it just attracts the normal tax rates, 15% on income, 10% on capital gains. So even if you had, say, $3 million, the overall average tax rate that you're going to pay inside super is still very attractive. I mean, it's very low. It might end up being 7% or 8%, probably even less actually. So the transfer balance cap was introduced in 2017, and it was originally $1.6 million, but the transfer balance cap gets indexed at increments of $100,000 in line with CPI. So there's two things that the government could consider doing. They could remove the indexation of the transfer balance cap, just keep it at 1.7 for the foreseeable future. And therefore, in real terms, if we include the impact of inflation, really in real terms, that transfer balance cap is reducing over time. Or secondly, the other option is to reduce it. And maybe they could make the argument to say, well, if you've got a couple, or even an individual, a couple probably doesn't need $3.2 million of super to be self-funded retirees. Because if I'm sitting in the government's chair, that's all I'm really worried about, is reducing the burden on the welfare system, rather than necessarily giving higher and higher tax benefits to wealthy individuals. So, if the government sat back and thought, well, maybe actually people don't need any more than, say, $1.5 million in super. And if that's the case, let's reduce the transfer balance cap. And I think they could do that and really not compromise people's retirements, but then again, raise some tax revenue. And arguably, I mean, if you look at Australia's super system, possibly you could make the argument to say that it's too favourable to higher income earners, and it encourages or discourages people to sort of pay their fair share, particularly if people have surplus investment assets, more money than they really need. Another possible change could be banning franking credit refunds. So if a super fund that's in pension phase receives a dividend, a fully franked dividend from a share that they own, and let's say that the dividend is $70 and it's fully franked, which means it'll have a franking credit of $30. Because the super fund's tax rate is nil if it's in pension phase, it'll actually get a refund of the $30 franking credit. So therefore, its cash dividend ends up being $100, the 70 plus the 30, rather than someone that receives that dividend outside of super. Their cash dividends probably end up being close to 70 or maybe even lower if they're on a higher income. And Bill Shorten proposed in his 2019 federal election campaign to ban franking credit refunds to super funds. So they could still get the benefit of the franking credits, but they just can't actually get a refund at the end of the day. Now, if you did that, that means that essentially super funds would be paying a 30% rate of tax on any dividend earnings from stocks that they own. The flip side argument, though, is so that's not good. But the flip side argument is, well, why should we be giving tax refunds? Why should super funds be paying zero tax? So I don't know if if the government would be brave enough, or maybe putting it a different way, stupid enough to propose a policy that didn't work for Bill Shorten in terms of winning the election. I think they're more likely to play around with some things like the transfer balance cap that I've said, put a cap on total super, maybe increase the tax on contributions from higher income earners. They're more likely to do those sorts of things, which is probably going to have a fairer application than really changing franking credit refunds. But I thought I'd throw it in there. You just never know what a government might do or be contemplating doing. The last changes that I think are inevitable is that the Albanese government has already proposed to make changes to some of the super rules that apply to industry super funds to wind back some of the accountability and transparency measures that the coalition government previously introduced. And there was something called a Your Future, Your Super performance test that the government introduced to really help people understand whether their fund is a well-performing fund or not, and if not, give them the opportunity to move where their super is invested. So under that performance test, the funds that were doing really poorly, you had to write to members to say, we've failed this performance test. This is what we're going to do to remedy the situation. But also here's some options including moving your super to a different fund, which I thought was a really good idea, particularly, the main funds out there, the performance is relatively similar, but then there's a long tail of super funds that are underperforming with high fees, etc. And it's a really simple fix for people just to move their super, and it's a really easy thing to do, doesn't take much time. So it was really good. Anyway, The Albanese government is canvassing changing those rules, and also they're also canvassing changing some of the disclosure requirements as well. So at the moment, super funds have to itemise all marketing sponsorship expenses, as well as political donations and payments to industrial bodies, and this is just to provide better transparency on what sort of money is flowing back really to the unions and also to the political parties. And so the Albanese government has proposed, instead of providing an itemised account, just aggregate the disclosure is sufficient, which clearly then you're not going to really know how much your super fund's given to the Labor Party or to a particular union or something like that. And I think that is, whilst it might not impact overall investment performance, if it was my super, that's something that I'd want to know about. Now, I'm very careful to keep this podcast apolitical, so I don't want to make a political statement. I'm absolutely not doing that. But the transparency and accountability obligations that the coalition introduced were minimal, I think. Just basic ones that probably should have gone a lot further than what they actually did. But it won't surprise me. In fact, I almost guarantee the Albanese government will wind them back because there is a linkage between the unions, the Labor Party, and so forth. So that they don't want that disclosure, and I'm sure it's going to disappear. And I think the industry super fund sector is weaker overall because of it. But just an important thing to be mindful of, I think. Okay, so how do some of these changes affect you and what should you be doing about it? So I think firstly is that it's important to point out that super is concessionally taxed. It's probably always going to be concessionally taxed because there's an incentive for the government to do that. There's an incentive to have as many self-funded retirees in Australia as possible because it does reduce the burden on the welfare system. So if you want it to be successful, you've got to offer some tax concessions in order to promote people to invest in super. So it's always going to be better than investing outside of super. And whilst people get sick of the government tinkering with a lot of these rules and changes, and I totally agree, by the way, because it really does reduce the confidence in the system. The reality is that super's always going to be attractive. It's just a question of how attractive. It's always going to be attractive enough to warrant contributing money. So it's never going to get to the point, I don't think, where it starts becoming unattractive or only marginally attractive. But at the moment, a zero tax rate on $1.7 million is very generous, I think. And given the government's debt situation, I don't think that level of generosity is likely to persist into the future. So, of course, they're going to change, have a play around with it, and it's something that we've got to expect. But at the same time, don't put all your eggs in one basket. And my view would be have some of your wealth invested in super, probably have some of your wealth in personal names, and then maybe some wealth in a family trust. And then that sort of diversifies your exposure and also reduces your legislative risk. That is that the rules change and that adversely affects your ability to retire. So the best way to deal with that is diversify that legislative risk by spreading your eggs in multiple baskets. So super is always going to be attractive, I think. It's always going to be the foundation of our retirement system. I think it will continue to be so. But it's just we might have to navigate some of these changes over the way. Okay, that's it for me for this week. Until next week, bye for now.